You know how sparing I am with my praise, but I do want to say that Henry's reports are among the few must-reads in finance. Henry, your latest report is called New Playbook Required. That in and of itself is provocative enough. Yep. You say in this report, we're living in unprecedented times. What do you mean by that?
Well, just pick up the newspaper. No, I mean, look, I think there are two big themes that are taking place that are secular shifts. One is the move towards, kind of, I'd say, national agendas over global agendas, and that clearly is affecting trade. And so let's come back to that. The second is, as you know, and we talk a lot, I travel quite a bit. I mean, I was recently in Mexico, Italy, Spain, and then in Shanghai last week. I mean, if you look around the world, including the epicenter here in the U.S., we're moving from monetary policy as the number one driver to fiscal. And that is leading to, I think, a different investment playbook in terms of what macro folks and asset allocators should be doing with their portfolios and their books.
Let's dwell on that for just a moment, because the word secular gets thrown around a lot.
Yep.
But when you say secular shift, it means that we're moving from one era into another era.
Yeah.
And the next era is going to look a whole lot different from the last era. Am I correct?
Yeah. And so I think what we try to do at KKR and through our written work and through our investments, I mean, look, we're investing 5 to 7 years, so we're hopefully getting the secular right, and the cyclical will leave to the day traders. But what our basic view is taking place is that post-crisis, central banks dominated around the world, right? That's what they did. We had
for 10 years.
QE, and now we're having an exit in the U.S., which is obviously the largest economy, and the Fed is leading the charge there. But at the same time, we've got a record low unemployment rate, and we're adding fiscal stimulus. There's no other time in American history where you've had the unemployment rate this low, where you were stepping on the accelerator. And there's some logic to that, which is if you have low rates and you can grow your nominal GDP faster, you can actually get some pricing power, you can get some wage increases, and you can actually reduce your deficit. But it's a balance. And so I think what we need to watch under the Trump administration is, does this investment and this stimulus lead to productivity growth? Because if it does, I think we're in smooth sailing. If it doesn't, we're going to have slower growth, bigger deficits, and a little bit of upward pressure on margins, which I think would be tougher for the corporate sector.
Before we get into the investment implications of that, let's go back to your first point about national agendas.
Yep.
Why is that so important? I think, of course, we see some of that also playing out here in the United States, but we see it in places like Italy. We see it certainly in places like Hungary. We see it in Turkey and elsewhere. Explain why this is relevant to the investor.
I think really what you've seen is when you did monetary stimulus, instead of creating a trickle down that benefited most of the population, you really created a massive socioeconomic divide. You ended up with the people that own stocks and bonds, who their assets appreciated, while at the same time it was really hard in terms of those with I would say the middle income, where you didn't get wage growth for over a decade. And so that has created a very polarizing effect, where you have a strong left and a strong right. So a lot of people like to champion what happened with Macron in France, where he essentially abolished, got rid of the left and the right, and he won and brought people together. That's definitely the exception.
He's the outlier.
He's the outlier. And so if you look at AMLO in Mexico, or you look what's going on in Italy, and to some degree in the U.S., you're getting a very different population, and the politicians who are playing to them, they need to create unorthodox policies to, I would say, to cater to that. And so we're entering a world where I think financial assets are probably more fully valued than economic assets or economic growth. And so it makes sense that we need to try to, I would say, benefit growth in the real economy. And that's really where we see global policy driving. And so we've tried to, from an investment standpoint, for our LPs, is to drive more investments where we're getting linked to that real asset growth.
How disruptive will the Trump administration's trade policy be, not just economically, but the financial markets?
Yeah, look, I think ultimately the U.S. economy is 70% consumer. Confidence is high, tax rates are low. In the near term, I think we've got very strong momentum. I will tell you, I was in China last week talking to business executives from both the Chinese companies as well as the U.S. And my overall view, and this is one man's view, is I think the market is overly optimistic about trade. And so I think the Trump administration is very focused on, one is autos, and then 2 is high-end technology. And our base view at KKR is that they will implement the $200 billion come September. And I don't think that's where the
This is the additional $200 billion of Chinese imports,
yes,
the tariffs that they have threatened to impose on August the 31st.
Yep, and I don't think that's not where I think the market is. So I think last time when we talked in January, I said the Fed was, that people were behind the curve in terms of the Fed would do more. And you said, you pushed me and said, that's a little crazy. I said, here's our view. What I'm saying today is on trade is that we probably think that has a longer tail than what the market today thinks. And it doesn't mean there's going to be an all-out trade war, but I think that the China 2025 plan is really, I think the U.S. administration is very focused on that, and probably for good reason. And then second is, I do think they want more of a level playing field around autos. And I think as we think about investments globally, that has impacts on supply chains. And so my team is spending a lot of time working with our deal teams and making sure that we're thinking through that and just have our bases covered.
So in as simple a set of terms as you can come up with, Trump aggressive on trade, more aggressive than the market anticipates. That makes, broadly speaking, what a buy and what a sell?
Yeah, I mean, look, I think our message is very clear, which is for the past 5 to 10 years, you wanted to get long duration. You wanted to own longer duration bonds. You wanted to own growth stocks. And what we're saying right now is you want to shift the portfolio to have more upfront yield. You want to own assets that are more linked into GDP growth. And you probably want to lock in your low-cost liabilities because structurally we think that rates have bottomed. And we're not bearish. I mean, in fact, I think we're pretty active, as you can see in the press, on where we're investing. We just have found
as a firm, yes.
As a firm, I think we've tweaked the playbook a little bit, as you mentioned. I'll just throw out one statistic, which is when you look at from a factor perspective, what's driving stocks today? It's momentum, quality, and growth. And at the same time, the market doesn't like value and it doesn't like cash flow. In our business, if you can partner with a company where they're underperforming on the cash flow and you can buy it at a reasonable valuation, you can reposition the portfolio and bring it back to the market, and people want to pay for growth and quality, that's a pretty good opportunity for us.
Let's quickly go through a few asset classes.
Okay.
Equities, you say multiples likely have peaked. Why?
Yeah, there are a couple of reasons. One is I think that margins have peaked. Two is I think the Fed is in the game, and generally, if you look at every cycle before this one, when that happens, multiples have hit their peak. So we're at pretty good levels. I mean, 17, 18 times is a reasonable valuation. So we don't think the market is wildly overvalued, but we think going forward we shouldn't be using higher exit multiples, and so that's a change for us.
You think there's going to be a correction in tech stocks?
I don't think there will be a correction today, but I do think that we're increasingly making our bets in terms of the equity market on tech. I mean, ex-tech, the U.S. market's actually not doing that well, and when you look at emerging markets, tech is now the biggest sector in the whole EM universe. That's never been the case before.
Why is your biggest underweight long-duration government debt?
Yeah, so it kind of gets back to my earlier comments, which is you typically in asset allocation or from a macro trader's perspective, you wanted to own long duration to provide some income, but also when the world ended, it would give you some protection. You
need to flip that now.
Yeah, now if we're spending more on deficits, we're making that long end more susceptible. So we're not, I would say, we're not wildly bearish on that the long end is going to explode to the upside. We do think rates have bottomed structurally, and I would just say what we're doing in some of our private credit books or our asset-based books or other areas, you can pick up multiples of yield, and the risk reward is just skewed in that favor.
Some people say the next crisis is going to be an emerging markets sovereign debt crisis, not unlike 94 in Mexico, not unlike 97 in Asia. Do you agree?
I don't agree. I think there's certain areas where, one is I think emerging markets is in much better shape. And we've got 8 offices in Asia. We're the single biggest player there. That's not my impression from traveling around there. There are specific markets such as Turkey where they are borrowing to both fund their buying of their consumer goods as well as the government. That's not a great scenario. So I think it's a more targeted, look, this has been a rolling bear market type of environment. Retail got hit, energy got hit, Turkey's been hit. That's more the environment we envision.